American corporations pay over $420 billion in annual federal income taxes at a flat rate of 21% in recent years. That's roughly $1.2 billion in taxes every single day flowing to the federal government. But there is a lesser known section of the tax code that allows these same companies to redirect their tax liability into a completely different purpose, and that is building affordable housing. So you have a company that has been successful that has generated massive revenue, which means now they owe the IRS a lot of taxes. Fortunately for them, there's a way to reduce their multi-million-dollar tax liability while helping to solve the housing crisis here in the US. It is called the Low Income Housing Tax Credit, or LIHTC for short, and it is one of the most powerful tax incentive programs here in the United States. Back in 1986, Congress created the Tax Reform Act, including Section 42 of the Internal Revenue Code, which created the Low-Income Housing Tax Credit program. Instead of writing checks to the Treasury, companies can invest in affordable housing that rents to lower-income families at below-market rents. They then receive tax credits that directly reduces the federal taxes they owe dollar for dollar. So if a company owed $100,000 of taxes and it purchases $50,000 of low-income housing tax credits, now it only owes $50,000 to the IRS. In order for this to be a smart move for the investors, the economics need to work, meaning the value of those tax savings must exceed what they paid for the credits. So developers will sell the tax credits to investors for somewhere around 85 cents on the dollar. It's almost like buying dollars at a discount to save money on taxes. So how does this work? Let me walk you through a real example of how these are allocated using Tennessee. Each state receives an annual allocation of credits based on their population. For 2025, Tennessee recorded about 7.2 million residents. The federal government sets a per capita factor. In 2025, that was $3 per person. 7.2 million people times $3 equals roughly $21.6 million annually in low-income housing tax credits. These credits get awarded based on each state's Qualified Allocation Plan, or QAP, which is basically the rule book that chooses which projects get funded based on listed priorities per state. While every state has different priorities in its QAPs to address local housing needs, there are common standards made by federal law that each state must follow. Before applying for tax credits, it's important to understand that there are two different types of low-income housing tax credits: the 9% and the 4%. In short, the 4% credit covers roughly 40% of the cost of construction, are easier credits to get, and can typically fund larger projects, think 100 to 300 units. Whereas 9% covers roughly 70% of costs, are extremely competitive, and are typically limited to smaller projects, think 20 units to 100 units. Check out my channel for a deep dive on the differences between a 4% and 9% credits. In this video, we will be using the 9% credits to illustrate all of our examples. To apply with the state housing agency for tax credits, you will need to fill out an application showing exactly how many tax credits the project will generate. Let's follow a deal from start to finish to show exactly how to do that. Imagine a developer who wants to build a mixed income community with 3 components utilizing the 9% credit. One building that's entirely affordable rental housing, one building that's mixed income rental, and a section of townhomes that are for first-time homebuyers and a few renters. Here's how to determine how much tax credits your development should apply for. Building A costs $4.2 million to construct and will be 100% affordable rental housing. Building B costs $6.8 million, but only 50% of the units will be set aside for low-income rental residents. The townhome portion costs $5.2 million total, but since 80% of the units are set aside for first-time homebuyers, only the 20% set aside for rentals will qualify. And this is because the LIHTC program only applies to rental housing. The qualified basis is the portion of construction that is eligible for tax credits, aka the portion of the building that goes towards building the affordable housing units. For building A, a $4.2 million qualified basis times the 9% tax credit rate equals $378,000 in annual low-income housing tax credits. For building B, only 50% qualifies. So 6.8 million times 50% equals 3.4 million of qualified basis. That 3.4 million times 9% equals $306,000 in annual credits. For the townhomes, only 20% qualifies for LIHTC. So 5.2 million times 20% equals 1.04 million of qualified basis. That 1.04 million times 9% equals $93,600 in annual tax credits. The developer submits an application requesting $777,600 in annual credits. That is the sum total of all the credits from all 3 buildings. If the state housing agency approves the application, then they will reserve the $777,600 in credits out of the state's pool of $21.6 million. An important thing to note is that the low-income housing tax credits are valid for 10 years per development. So every year, this one development will receive $776,600 in credits, totaling over $7.77 million in credits over 10 years. So my first 2 tax credit applications that I ever filled out were due the day after Thanksgiving, and I massively underestimated how long they were going to take me. They gave us a really short submission window, and with every T needing to be crossed correctly, I ended up roping in my parents and my brother to help finish my applications. We were racing against the clock, trying to get these applications finalized and then into UPS 30 minutes before their deadline to ship it overnight to the allocating agency. The lessons: first, over-prepare so you're not scrambling last minute like I was. Second, don't let bad timing scare you off. Because so few groups applied that round, my first 2 applications were both awarded. Once the developer secures a tax credit reservation and meets preliminary benchmarks, investors enter the picture. The investors typically join as a limited partner in the deal, meaning they invest capital into it, but they do not manage the day-to-day of the deal. Here's what makes all of this work to secure credits that are attractive for developers. If developers structure their project to maximize tax credits, the capital the investors pay for the right to claim those credits typically covers about 70% of the costs. This allows developers to finance the majority of their property with investor equity capital rather than using traditional bank loans, meaning that there are no interest rates involved on roughly 70% of the costs. That is a massive cost savings for affordable developers. Remember, this project generates roughly $7.776 million in credits. Investors typically price LIHTC credits anywhere from 75 cents to $1.05 per dollar of credit. This pricing depends on things like the investor's need for credits, the market conditions, and the deal quality itself. For our example, let's say that investors paid 95 cents per dollar of tax credit. Here's the math. $7.776 million in credits times 95 cents on the dollar per credit equals $7.387 million that investors pay upfront to help pay for the cost of construction. This covers about 73% of the total $10.2 million in construction costs. That is between the 3 projects' qualifying portion of basis. They invest $7.387 million upfront and receive $7.776 million in tax credits over a 10-year period. That's a gross return of about 5.3% over the 10-year period. But here's the key. These are tax credits, not taxable income. So if the investor is paying 21% in corporate income taxes, those $7.776 million in tax credits are worth the equivalent of about $9.836 million of pre-tax income, making the effective return much higher when you factor in the tax benefits. When I first started, I knew investors would focus in on the numbers, but I learned very quickly they also wanted the deal story, how the deal came together, why the community supports this project, and why it will succeed. Before signing off on the project, they will walk the site with you, see the neighborhood, and make sure that the vision matches the reality. But the buildings cannot be leased until they pass inspection and get certificates of occupancy. This is the official document stating that the building is ready for residents, depending on the specific program requirements that you agree to. Typically earning no more than 30 to 80% of the area median income, depending on specific program requirements. Following the income restrictions is crucial to receiving the tax credits. After the buildings are constructed and initially leased up to qualified low-income families, the partnership wants to start claiming those valuable tax credits. But first, they must submit a placed-in-service package to the state housing agency. This package is essentially a mountain of documentation proving that the partnership did in fact deliver on all the commitments from the original application. We're talking certificates of occupancy, loan documents, architectural agreements, permits, and most critically, an audit of the final construction costs, verifying they were in line with the original projected costs. The developer submits this package to the state agency for their review. Working with partners who have experience in LIHTC will ensure that this is done correctly. This is like your property management company doing income verification, your tax credit attorney verifying all your legal documents, and your financial auditor making sure all of your costs match up to your estimates. Upon approval, the state agency issues Form 8609 for each building. This is the golden ticket that gives the partnership permission to start using those tax credits on their federal tax returns. The final piece involves actually claiming the tax credits. Since real estate partnerships are pass-through entities, meaning they don't pay federal taxes themselves, the tax credits flow through the partnership to the individual partners. Typically, 99.9% or more of the tax credits go to the investors, who then claim them on their own tax returns. And the tax credits can be claimed annually for 10 years. You need property managers and tax pros who know LIHTC inside and out. One slip on compliance can cost you credits. That's why I make them part of the core team starting day one of any new affordable development. The Low-Income Housing Tax Credit Program has been operating for nearly 40 years now and created over 3.7 million new affordable rental units as of 2023. It represents a great example of partnership between private capital and public policy goals. Companies get valuable tax benefits, developers get financing tools, and communities get affordable housing options. And with historic funding and unprecedented demand, the timing has never been better to create more affordable homes. And if you're interested in doing your first affordable housing development, click the link below to apply for our Affordable Development Mastery coaching program. Thank you.